Hey guys, what's up? This is Francisco with Valoresa Capital, and today I just wanted to bring you a quick video explaining what is the 21 exponential moving average, why do I use the 21 exponential moving average with my edge, and why do I consider the 21 exponential moving average to be one of the strongest technical indicators out there in the market, and why do I consider it to be really easy to use, really easy to understand, and that's why I want to explain it and bring it to you today in this video. So first of all, let's start with what exactly is an exponential moving average. An exponential moving average is basically just a technical indicator that we use to track the the recent price movements in an asset or a security. For example, as you can see right here in my screens, I have Tesla. This is the action in Tesla from 2020. This is all this price action is before Tesla announced the split. And basically the 21 exponential moving average, as you can see, is a really important, just by looking at it you can see that it is a really important moving average in terms of support and resistance, and in terms to identify a trend in the market or the stock in this case. So first of all, if you guys want to get more in depth with the formula, I have the formula right here for you. This is the formula for the 21-day exponential moving average. And as you can see, the 21 exponential moving average uh, puts more puts more weight on the recent price action. As you can see, puts 9% more weight on the recent price action in comparison to the other kind of moving average that a lot of traders use, which is the SMA, which is the simple moving average. Basically, the difference between a simple moving average and an exponential moving average is that the simple moving average is gonna put the same weight on all of the candles for the calculation of the moving average. For example, the 21-day simple moving average is gonna weight the same factor in each of the candles, so it's gonna get a different result from the exponential moving average. But what I like about the exponential moving average is that it adapts faster since it is putting more weight, as you can see in the formula, to most recent price action. So now let's go back to the chart and let's go into the two more into the let's go more in depth into the two most important things about what exponential moving average does and how we apply it in the market. As you can see, the 21 exponential moving average in my screen is the blue line, is the basically the only line in my chart right now. And the first thing that you can see is that whenever price is above it, right? Whenever price is above it, we can see that is a really good place for us to find support, right? We can see support as a floor for price. And whenever the price is below it, as you can see right here, we can see that the 21 exponential moving average usually is a place of resistance, or we can call it a ceiling for price. So, why do I consider the 21 exponential moving average a really important tool for my edge? Is because I see the 21 exponential moving average as the mean for price. And why do I mean by mean? As you have learned in probably you learned in high school when you were taking math, or you have read about it. Basically, the mean, as we usually hear about it, everything that gets extended reverts back to the mean, and that applies to the prices in the stock market as well. And as you can see, for example, in this chart of Tesla, we can see that whenever the price get extended, it always reverts back to the 21 exponential moving average, which is the mean. And now, a simple way to see this is that whenever price is below a 21 exponential moving average, we should see this as possible resistance above whenever the price get extended. And of course, as soon as price breaks that 21 exponential moving average, the the different is it happens differently, right? It's no resistance anymore. We should expect the 21 exponential moving average to act as support. And I have a couple more examples to show you here, guys. I have also an example here in Apple and in the QQQs, right? We can see that the 21 exponential moving average, as soon as it's broken, it tends to act as resistance when we have a bearish trend. And as soon as the exponential moving average is broke to the upside, we tend to see the 21 exponential moving average to act as support. And then the opposite happens again when price breaks below that exponential moving average. We usually see that it acts as resistance, and then we usually see moves that follow that trend. So this is basically a really easy tool to use. Uh, a really common rule would be as soon as we get a couple, at least two daily or three daily closes above that moving average, we should expect price to follow the path of least resistance, which is higher in this example. Or as soon as we get three daily closes below the 21 exponential moving average, we should expect price to decrease at a faster rate. And then finally, my last example is here with the QQQs, and you can see how powerful something as a moving average is when we have an established trend, right? For example, here we can see that as soon as price broke above this 21 EMA, we retested it as support, and then we just traded above it, and we found support many times in this moving average, and you can see that we got really strong moves out of that moving average. And then the opposite happens. As soon as price closed below it, we should expect that moving average to act as short-term resistance until then we finally broke above it and we moved to the upside. So basically, just to summarize what an exponential moving average is, it's just a technical indicator to track the changes in prices. Uh, and also, we have two main applications for it. The first application is to highlight a trend. So to identify the trend, if we are above it, the trend should be to the upside. If we're below it, the short term trend should be to the downside. And of course, as we mentioned, to identify support and resistance levels for price. As you can see, resistance here and support here. So this is something really useful to use, guys. In my experience, the 21 exponential moving average is one of the most important exponential moving averages out there to track prices in the market, in the stock market, and it's something really easy to use. Just keep it simple. If price is above it for the last 3 days, you should consider that the short-term trend is to the upside. If the price is below it in the last 3 days, last three closing candles, you should expect that the path of least resistance is to the downside. And of course, the 21 exponential moving average can be used in any time frame. My preferred time frame, since I'm a swing trader, is the daily time frame, and I have found that in the daily time frame, this is a really strong place for support and resistance, a really strong level for support and resistance, and you can find a really profitable strategy just by using this indicator by itself and understanding price action. So if you guys have any question, let me know in the comments. Don't forget to like and subscribe. It really helps me out and it really helps my channel. And if you got any idea of any other topic that you want me to cover, leave me a comment below. And thank you so much, guys, for watching. Have a good one and good trading. Bye bye.